So just to summarize, what we talked about in the last segment, because we're coming into the midterm elections, and the Fed is obviously trying to get in front of this, how quickly, all these things we're going to talk about. And this is why. When you look at the single most important problem, you can get an idea that it's inflation. It's topped quality of labor, taxes, government red tape, everything. Inflation is the number one thing that people are concerned about and businesses are concerned about. So, and when you look back through since 2000, we've never been this high on inflation being a concern, which is why there's such a kind of laser that's honing in on how do we address this and how is this addressed going forward. And the reason why is when you look at ISM Manufacturing New Orders rolling over, what happens to margins? You have orders rolling over, you have prices going up, you have wages going up, you have this pressure point, where are corporate margins? So then when you look at company offered guidance, you get an idea that company offered guidance is negative, conveying companies' pessimistic outlook for future earnings growth. Earnings slowdown is another metric that goes against largely high valuations in the equity market. So when you look at what's happening in the equity market, where some of the pressure points are, you just look at guidance. Like people are saying, look, things are getting a bit unknown. We're going to be a bit cautious because we're spending, where's our cost going? Can we cover that cost? Can we pass it through? And again, that's that contraction on margins, which is why businesses are so focused on inflation. Now, when you look at just an example of that, higher prices are widespread and being reported by 72% of small businesses, but only 3% are saying that poor sales are the most important problem. So they're still not seeing that degradation on sales. And that's when you start to get that pivot, is when you see that bigger contraction on margins, especially on the small business front. So then when we put it all together, an inventory sentiment worsened in March per the ISM, and then the PMI, but improved for ISM manufacturing, relative improvements of lows have been consistent with a bit of a pickup in inventory sales ratio. So this is when you're still getting that kind of pivot from sales, but getting, services getting a bit better, manufacturing getting a bit worse, and kind of how that all, connects together. And again, seeing that connection over the next few months. Then when you look at the long-lasting, so economists polled by Bloomberg are expecting a higher inflation per the April survey, expected to average 5.7% in the final 3 months of 22, up from 4.5% estimated a month ago. Again, you keep seeing this movement up as it gets less, more sticky, less flexible, more longer term, and less, to use the famous word from the Fed, transitory. So now when you look at the wage growth tracker, lowest earning workers in the blue with the strongest wage gain, with the green, in the green, showing wage gains on record. Wage growth also up for the highest paid cohort, which is that, again, the fourth quartile blue, but not nearly as strong. Now, this is a bit misleading because you can fall out of a wage level into the next one. So regardless, you're seeing these increases, but is it enough to offset wages? And as we showed in the inflation, as we showed in the first segment, the answer is no. So when you look at what the Fed can do, right? The Fed can raise rates. So what does raising rates do? It makes your savings account grow faster because it's going to invest in bonds. Yields will go up. It'll make your money market account grow a bit faster. It will enable some slowdown in terms of pricing, get some of that inflation under control, and help your wages go a bit further. Now, those are some things, but at the same time, it'll also cause companies that can't borrow as much, cost of borrowing goes up, they have to let some people go. But given some of the flexibility in the jobs market, it can tolerate that. So again, those are some things that we could start to see to bring things back in line. Now, wage growth tracker by occupation, you could see the high skill, everything is moving up, but it's still a matter of how are we going to do it. And it's interesting because now this isn't just like a plant to pitch nuke, but it just shows you kind of where we are on the energy front. Because when you look at energy availability, the production of wind and solar power is encouraged by 72% of the people that were polled. with production of nuclear power at 35%. So the problem is wind and solar are intermittent. And if you start looking at energy demands going up, energy prices going up, you're starting to see this hit harder. And when you look at the number of nuclear power reactors gradually declined in the past 3 decades from 107 to 93, and probably by the end of the year by about 90 as we have more slated to be closed, we really have to look at the base load. I get everybody wants to hit zero emissions, but we have to look at, well, how do we do that? And how do we do it on a base load capacity where I know this facility is going to produce 97% of the time? Because I need my base load capacity to be firm, to be consistent, and then I can worry about that flex on the other side. And that's where you see costs remaining elevated, especially on the energy front. And we're already seeing that in Europe. And Europe is kind of the perfect example of how high energy prices are and how we're essentially, speeding towards the same type of issues. But now when we look at that and we look at energy and some of those offsets, now you start looking at where should the rates be? And that's when you look at the neutral 2-year yield and the actual 2-year yield. So and then the 5-year and then the 10-year, you're seeing that quickly ramp up to kind of close that gap because there's so much of this unknown that we were way too low. And as we said in February of last year, which clearly was a bit early, we said that this was the end of the bond bull market. We've been in a downward trend, and we'll show that in a chart. And now you're starting to see kind of that unwind and this changing paradigm, which is hard to accept, takes a long time, but that's where we're starting to see this pivot. Now, yields have been protected because of the Fed and because the Fed has been a big buyer. And there have been periods where the Fed was either buying every single thing that the Treasury was putting out, or very close. So when you look at the net issuance of bills in Q2, Q3, the Fed was above it. But now, as we progress into Q1 and now Q2, where not only do you have the Fed not buying, you either have them as an active seller or just letting things expire. So realistically, your biggest buyer since Q1 of 2020 is now gone. And what is that going to do to yields, given that other places, other regions are in such a struggle, are in such dire straits? How are they going to be able to buy up some of these treasuries? And they may, but at what interest rate, at what yield? And that's, I think, the bigger question. Now, all of that coming back to the market is pricing the total Fed funds rate increases for 2022 to 2.52%. So the expectation is that as we exit the year, we are going to be at 2.52% on the rate side. And then the market pricing for the number for the May meeting, which is obviously next month, there is now pretty much 100% chance based on expectations of having a 50 basis point hike. Now, the thing that's important to consider when you look at inflation, and this is some of the things that I always like to point to when there's an argument about how inflation is measured and prices and costs. Inflation didn't budge during prior tightening cycles. And it's when you look at the different periods, it takes time for this to work through. And it's more along the lines of a stagflation, where you essentially enable people to afford the inflation by raising rates and increasing their abilities by having more in savings, having more in their money markets, yielding more on interest. And that's how you saw some of these get impacted. But inflation really didn't budge during those prior tightening cycles. And that's why when you look at what the Fed can do to get things under control, it's going to be very difficult, especially based on the pace and the rate of change that they're going to try to adjust. But again, you're looking at a very difficult period. Again, this is only looking at the 80s onward, because we haven't had many of them. But when you look at the 70s and then obviously the late 70s, early 80s with Volcker, He had to jump the shark. He had to go, look, I'm going to get ahead of this, and then that was when it really dropped. But in the prior tightening cycles, you didn't get much movement because there was this unwillingness to go to the extremes. And given the rate of change that we're seeing and the pressure that we see abroad coming in, that's going to have to adjust a bit. Now, easy money, the federal funds target rate after inflation, you can see is at -8, which is the lowest it's ever been. Again, just showing how far behind they are on the increase in rates. And now when you look at the 10-year and you look at the downward trajectory we've been on since the 70s, this is kind of that bond bull market we've been talking about. And this is where we're going out on the limb and saying that the bond bull market is ending and that you're going to see these rates continue to move higher. So then when you look at the 1 year ahead household spending growth expectations, it continues to move up, and it keeps, again, it's moving further and further higher. But then when you look at Powell and what could happen, there was, where are we going to get this? This should reduce wages. So wage growth and labor slack. The idea is to try to collapse this down and try to bring this under control when you look at that labor slack and where things are going over. So now when we start looking at the market and their pricing in a more aggressive monetary policy, because they're looking at this and saying, okay, well, you can't have the wage spiral like in that chart that we were showing. So you need some of this to come under pressure, and the only way to do that is to get a more aggressive movement in the Fed funds. But then when you look at the assets in the Fed's balance sheet, it's 23% of GDP. So with the Fed's new runoff expectations for balance sheet by end of 2024, balance sheet's value as a percentage of GDP could fall to around 23%, down from the current 33%. So it gives you an idea of we're sitting at 37% with a target of 23%. That doesn't happen just by letting things expire. You need to actively sell, which again is going to push rates up and put things under pressure. So then when you look at the CPI monthly change, again, with all of that back in your mind, energy is going to go back and forth. That's the flexible piece of it. So that will come down. But when you look at housing, food, other goods, other services, that is where we continue to see this movement up, where the pivot from that flexible to the sticky side continues to accelerate, keeping pressure on the underlying consumer, which is where you look at the optimal 30-year conforming fixed mortgage rate at 5.06%, right back up. So again, if you didn't refinance your mortgage, you missed it. It's back up. It's unlikely to come back down. And that's, again, going to impact the way housing and sales are going. And then the 3-month rolling changes in real merchant wholesale inventories remain elevated. They're above where they were in 2011. And as that remains higher, you don't have to pay for the shipping. You don't have to see the freight moving the same way, which is what we've started to see in terms of the logistics, as we've been talking about on the EIA show. So then when you look at the Fed's balance sheet, you have to understand what's in it, because we talk about treasuries and the pressure it's going to put on, but we haven't really talked about the mortgage-backed securities. So this is what they were buying to help keep mortgage rates so low. So now when you look at how are they going to liquidate and bring their balance sheet back into that 23% of GDP target, well, how do you do it? And this is when you start looking at I think you'll see an accelerating sell down of MBS, putting more pressure on mortgage rates and housing. Now, when you look at the Fed assets sitting at about 37% of capacity, and when you look at a cap $95 billion per month over the 3-month period starting in May of the sell down, when you can't just let it roll off. If you just let it roll off, then you won't get to your target of 23% until essentially the end of the decade. So in order to get to 23% of GDP, you're going to have an active selling process. And even at only $50 billion, it's just not enough. And that's where you look at how they're going to achieve it. Now, given they could adjust and say that, look, the 23% of GDP isn't attainable, so we're not going to be able to get there. But this is where we see more pressure and how they're going to try to get to that level, keeping rates elevated and prices under pressure. Now, the consumer borrowing surged in February by most on record to plus 41.8 billion versus the estimate of 18.1, because again, higher costs. People have spare capacity on their credit card. They have spare capacity on equity, and they went out and got it as revolving credit rose 18 billion, the largest on record. And all the while all of this is happening, all the pressure that we keep talking about, the retail flows and cumulative performance, people are still buying the dip in the equity market. So all of these things are happening, and yet people still can't stop buying stocks, which again leads to more pressure and more of the inevitable drop, which again is just right around the corner. But God forbid you get people to listen. So components of the HPSI, good, bad time to buy and sell a home. So obviously, when you look at a good time, respondents who say it is a good time to buy. And then when you look at net good time, it's negative 49%, because people are saying it is a bad time to buy a home, obviously because of where prices are. Now, who say the economy is on the wrong track continues to go higher. So 73% of people who were asked said that consumers in March who say the economy is on the wrong track, 73% said it was on the wrong track, 21% on the right track, obviously showing the pressure. As more people get evicted from their homes, eviction filings are above historical averages in half of the cities that are being tracked in this chart. Between February 27th and March 26th, the most recent 4-week period for which the Eviction Lab have complete data, filings were over 100% of normal in 14 cities, and there were 4 cities that were 150% above normal, again catching up on that backlog. All the while, MBA purchase index continued to weaken. It is now below, obviously, where it was in 2019, in 2021. As things cooled off, MBA purchase index, again, weakening, all showing some of the same slowdowns in the real estate sector. But at all the same time, new apartment completions will continue to surge in 2020, which will help combat the record low vacancies. So not only will there be evictions, which will help, but also new units. So that's what we have for you for the U.S. In the next segment, we're going to go through Europe and some of the pain that we're seeing on the leading indicator side and where that's going to go over the next few weeks.